Well, welcome to another edition of the Alpha Dog Capital Deal Flow channel. And today I'm talking with my friend Scott Carson once again. We're going to be talking about note buying, but specifically, I want to focus on commercial property and what's going on with foreclosures and big apartment complexes and other commercial property. And Scott is going to fill us in on that. So, Scott, welcome to the podcast.
Oh, good. Is it my alpha dog howl, basically? Glad to be here, John. Glad to be here, man. And good to see you, buddy. Been too
So
long.
yeah, good to see you. I see you all over social media every day. And for a couple of years, I've been hearing from, contacts that I have in the industry that apartment complexes are going to be foreclosed on and, commercial is really going to take a nosedive. And, I've seen it a little bit myself, but they've been kind of, let's say, not forthcoming with specific information. But man, you are on there showing pictures of these commercial buildings and giving specifics of prices and when it was bought and what it might be sold for closed for now, what the value might be. So just from a big picture perspective, before we get into any specific deals that you know about, what is going on with is it commercial property in general, or is it specific multifamily, or just kind of define that as well?
So I will tell you that history has a habit of repeating itself, right? Okay. And when I first got, actually, I'm celebrating like in a week and a half, I'm celebrating my 20th year anniversary as an entrepreneur, real estate entrepreneur, where I left my last job.
Well,
And it's,
congratulations. That's
thank you very
awesome.
much. Thank you very much. So basically, back in 2008, we started getting bombarded with distressed commercial debt, and the commercial stuff in 2008 and 2009 happened before the residential stuff
Mhm.
because the residential stuff is delayed with foreclosures and all sorts of bankruptcies and banks, stuff like that. But we started seeing a lot more um, commercial loans going to default to kick off the recession. And a lot of it was small balance in apartments that were overpaid a few years earlier. Well, as I've been watching this, multifamily, specifically office space too, for the last few years prior to COVID was really overpriced. It was the most expensive asset, most overpriced asset class out there. And you had people that were just buying it. Banks were glad to finance it at 60 to 70 cents on the dollar. And investors could technically kind of afford that, even if they're paying it 70 cents on the dollar, because they were getting cheap interest rate loans.
Mhm.
And then they were bringing the other 30% on average to the table in the form of syndications, and private investors were funding that backstop. Well, that makes a pretty secure loan for a bank in a lot of cases. Well, most of these multifamily apartment investors, the whole idea was, oh, we'll hold it for 3 to 4 years or maybe 5, and we'll refinance. We'll regentrify the asset and we'll refinance out, cash out our investors, and make $1 million and go, toodaloo down the road. Well, we all know what happened. COVID kicked in, and then also the rates went through the roof.
Mhm.
And the thing is that when these loans are starting to mature, which is what we have happening right now, we're going to have, I don't know, something like $100 billion in matured loans coming to maturity here in the next 6 months through beginning of the year. I think that was much bigger than that. I think that's just in
Right.
one market. Um, Banks, the paper isn't worth what it was written on beforehand. Now with increased interest rates and obviously management in a lot of these multifamily deals, the debt service coverage ratio, DSCR, which they usually shoot for, is like 125% of cash flow coming off of the debt coverage. Well, that number is not being hit in a lot of cases.
Mhm.
And when a interest rate on a loan now is going to be double or triple what it was, that's going to reduce your net operating income. That reduces the value of these apartment complexes on a cap rate basis. So now the banks are going to say, listen, if you're going to refinance, that's great, but you need to now bring an additional 20-30% to the table, because we don't value it at 10 million anymore. We value it now at 6 million.
Mhm.
And you've got to do that. And so that's what we're seeing. We're seeing a lot of these hotels. Office space is a whole different thing we can get to in a second, but hotels, apartment complexes, commercial properties that people overpaid, and they can't go back to their investors and ask for another 20-30% in cash, in a cash, in a cash call to get it. They're basically losing. The banks are foreclosing, and the banks aren't. I mean, some of them are working it out, trying to maybe a pretend and expense mentality, but for the overwhelming part of the stuff where this has been, privately financed or Wall Street financed and stuff, they're just foreclosing because look, if they can foreclose They're going to wipe out any junior liens. And we've seen some of these properties that had huge liens attached to it, from vendors and rehabbers and city liens and municipalities, where they're not paying what they need to pay because people got in over their head. And banks are foreclosing. I mean, here in Texas, especially, I'm repping with my UT hat today because I'm in Austin. Austin's been one of the darlings of the real estate markets out there. San Antonio, just out there. But San Antonio is literally, I can almost hear the nuclear bomb going off in the multifamily market. This month alone, $100 million, basically over 4 to 5 apartment complexes, is set to go to the foreclosure auction here on July 2nd. And that number is probably going to be doubling each month for the next 6 months.
So typically these loans, when the deals were originally put together and the bank gave the loan, on these types of loans, how long is the term? When does it reset? It's baked in when they get the loan originally, right?
Yeah, it's usually it vary, maybe a 3-year to 5-year term. I mean, some people like to try to get 10 years if they can, and those that have those 10-year loans, it may be a little bit higher interest rate, but it fixes them for a while. Now, those that were bought 3 years ago and 5 years ago, they've got to refinance. Well, what's happened, like one of the apartments I talked about yesterday, it was purchased in April of 2022. It hasn't even hit the 3-year mark. And since Texas is such a fast foreclosure state, when we can foreclose, you get 90 days behind, we can foreclose in 21 days. And the banks are like, this is not getting any better. Your cash flow is not covering it. So instead of us, you continue to not pay and management to keep going down the drain and things not be taken care of, we're just going to foreclose and take it over and try to get our money back on a resale side of some sort, or operate it for a while.
So a lot of them, from what I see you posting, that even if the bank forecloses, they're not going to get enough to pay off the debt that they loaned. So
yeah, exactly.
Does that motivate a bank to maybe slow down the foreclosure process, or are they more motivated to get it off their books? Explain that world a little bit, because there's a lot of moving parts there.
There is a lot of moving parts, and it's all going to depend on that individual bank's balance sheets. Now, banks are heavily regulated. For every loan they have on their book that's non-performing, they've got to keep a specific amount of cash reserves. And if a bank is keeping cash reserves, they can't lend that money out 10, 15 times on mortgages or loans, and that affects their profitability. Now, what's hurt the banks previously is that many of them were bought into bonds that were at 2%. Now those interest rates have gone up, bonds are at 5%. So they're losing money on those investments. They're losing money on these banks, not in the banks, on the actual apartments, the commercial stuff. So they're looking at, like, we need to get what we can now. We just need to write it off, get it off our books, because we can get something back. That bad loans no longer our books. Now we can make up a chunk of what we lost on new originations, new loans, and stuff like that.
Okay. Yeah, that makes sense. That's like real insight into how this world works. A lot of people don't understand that. Why would a bank, take a loss? But they're getting double jeopardy, right? They're getting negative cash flow or no cash flow from the asset, and then they've got other capital tied up in addition in reserve. So it's better just to get rid of it, get rid of the debt, and move on.
Yeah, I mean, that's the thing. Try to get what they can and move on from there. There was a new, let me pull it up here real fast, see if I can find it. There was now San Francisco, different parts of the country are different, especially office space.
Yeah, that's a good point. This is very market specific, especially with these types of deals and transactions and properties. And
I was talking to a guy earlier today, and he was talking about, and he was out in San Francisco. Now, San Francisco, it's going to be the next site of the newest Jake Plissken movie, Escape from the Bay. You've heard Escape from New York, Escape LA. Well, now they're not going to have to hire any extras, because all the homeless and the druggies are going to look exactly like the zombies in those movies. Okay. And there was an office spot out in San Francisco that sold, I want to say it sold for 90% discount what it sold previously.
90%?
Yes, here it is. I just pulled it up. It's let me pull it up here in a second. All right. So it's, previous owner paid $62 million in 2018 for a 90,000 square foot building. This sold for 90% less what it's traced. Okay, yeah, it's was purchased by a Starwood affiliate for $6.5 million.
Wow.
Down from the $62 million it was sold for in 2018. but it's downtown. It's kind of in that no man's land down between the Civic Center and then the main area downtown there. It's at 995 Market Street. Which, let me just pull this up, and
So
if you
this
want
is an acquisition that was made prior to coronavirus or during coronavirus?
to 2018, prior to
Okay.
COVID. It sold basically at what would that be? If it's 62 million at 90,000 square feet, a lot. It was basically 700 a square foot. Now it just sold for $72 a square foot.
Yeah. Wow. So that's incredible. It's astounding when you think of the numbers. Just kind of pausing just a bit. So a $60 million deal, typically the investors would borrow what, 75% of that, let's say, or what?
They probably would borrow something around 60 to 70 at the highest. It'd have to be
70.
really
Okay.
difficult. Now, usually what we're seeing now too with new loans, especially new financing with banks, used to be if you got a loan with a bank, you just got a loan. You had a broker that reached around to find favorable rates for it. They kind of shop the loan. Well, these days banks aren't allowing you to shop it. They want to have the actual banking relationship with you, so that their deposits are in hand as well. So now it helps them with the reserve balances they need to keep by actually having a banking relationship. So that makes it even harder to get stuff done.
Right. So
So,
they're
so
loaning, let's say, just hypothetically, it's a $60 million purchase. The bank is
yep,
putting up $36 million.
yep,
And what is that for the investors?
about 24 million.
24 million. So this is like private investors that family friends, and not family friends necessarily,
Well,
but
family
bigger than that.
offices, you could throw that in there.
Yeah,
Yeah.
family offices, syndications, and people investing their retirement money or whatever. Private individuals putting up $24 million, and the assets sold for what did you say,
Six.
7 million?
Yep. So the bank took a
So
huge discount. You took a huge haircut on that
yeah, the investors lose all their money in
yep.
that situation. They're wiped out, and the bank
Yeah,
takes a huge haircut. Yeah.
exactly. So, and that's the thing is, if the banks, I don't know what they're thinking. Some are trying to work it out. Like we just had the Fairmont Hotel here in Austin, Texas, that was on the commercial watch list. Means it was starting to fall. The debt service ratio was starting to fall below 1.25. Well,
Hmm.
they just refinanced. The lender refinanced them and extended the loan for a few years because they don't want to take the hotel back here. And it's right downtown on 6th Street and Rainy Street. Beautiful hotel. And so it's all depending on what the bank's at. Some banks are more desperate. I mean, the big telltale sign is that banks every quarter have to file their quarterly report on where they're at with their loans, their profitability, how much loans are in default, residential, commercial, how much is in basically coming down the pipeline. It's already starting to be defaulted at 30 and 89 days. So you can kind of tell, who's in trouble ahead of time.
Okay.
And there was a report out that they said there's about 68 banks where their commercial debt, the loans they had in their books, was 130% of actually the value of the assets. So they're upside. The banks are upside down on this
Right.
commercial debt, which is crazy. So there will be more bank failures. There's going to be some funds that have already gone out of business. Syndicators, definitely. I feel sad for the a guy out of Dallas. What's his name? Last name is Wolf. He bought back, in the last 4 years, he bought 3 big office complexes, one in Fort Worth, one in Dallas, another one in Cleveland, with the goal of converting that distressed asset. Office has been distressed since COVID, obviously.
Okay.
Completed the construction on, retrofitting and putting, turning into a multifamily apartment complex. Well, the Dallas one went to foreclosure 6 months ago, Fort Worth 5 months, and Cleveland goes to foreclosure this month. 3 out of 4, and one in Atlanta. One in Atlanta is the next one that's set to go to foreclosure next
Yeah,
month
I
too.
saw a post by you on that, and the one
Yeah.
that you just mentioned that they converted to multifamily. So, I remember when that was happening and during COVID, that was like a big play that the
Yeah.
commercial guys were talking about. Let's convert all this empty retail space into apartments, and now they're supposedly coming online, but if they're upside down, they're just so we have these renovated commercial office buildings that have been what do you call it?
Transferred, I guess, or
Transferred or
you know,
transformed. Yeah,
they've gone through their
transformed.
transformation, basically. You know what I
Yeah.
mean?
So now it's an empty apartment building that is upside down on their mortgage. They're going to get foreclosed. Somebody's going to pick up really good deals,
Yeah.
aren't
I
they?
mean, if you got some dry powder, and there's a lot of Wall Street guys have been sitting on the sidelines waiting for this. I mean, it happens. It happened back in the 80s during the RTC days, or the savings and loan crisis. A lot of commercial real estate was picked up for pennies on the dollars. It happened back in 2008 to 2014 on that
Right.
stuff. And so we have it happening again. And the thing is if people say, oh, it's, real estate's great, the markets are great. Look, this is the big domino that's falling. I mean, this leads to a lot of other defaults, distress in the market, and it's just not, it's not something that can be stopped overnight. We're going to see this for another 2-3 years. I'd be willing to bet. And it's just, you gotta work with it. If you're in a syndication, you need to be really touching base with the operators. Hey, where we stand, when do these loans mature, and be proactive in talking to the bank ahead of time.
Yeah, I've heard that there's a lot of investors in these syndications, private individuals. They don't really understand that this is coming. They've got money in a project. They think it's great. It looks good. The pictures are fantastic, and all the verbiage coming from the GPs or the general partners of these syndications are,
Yep.
always as spun as positive as they can make it. But, somebody like you, Scott, you have access to data and information that the average investor doesn't really bother to search for, doesn't know, or doesn't have access to, or whatever. And this is really important for investors to understand. Their money might be totally jeopardized of losing everything they put in.
Yeah, I mean, there's a couple of resources I'd be glad to give your audience. I mean, these are, you can always go to crexy.com. If you're in the commercial real estate side, you're probably familiar with them, and reach out to their data side. They've got like a monthly membership where they can actually pull up all the loans that are maturing. But I actually like Cred IQ. It's cred-iq.com. And what Cred IQ does is they're really linked into all the special servicers at the banks and all these third party. And I think they'll give you a week for free. It's kind of expensive, like $500 a month to have access otherwise, but that's a small price to pay if you're really doing these bigger deals, But these guys are so good at pulling information on from the special servicers, behind the scene notes, what's going on with the asset pulling, the cash flows, who the operators are, the LLCs. Literally, it's a treasure trove of information if you're interested in the commercial credit side. And I can search, what's going on in Texas, or I can search by specific asset. So that's one great thing that is just valuable, where we get a lot of our information from, and then just trying to share. And of course, anytime you have a foreclosure notice that's filed public record, that's public record. People can see that every month. And so keep an eye out. It's every state's a little bit different in how they diagnose foreclosures. If you're in a judicial state, there's going to be a lis pendens filed before the foreclosure. If you're in a non-judicial state, you're probably going to have a notice of default. In most states, Texas doesn't have doesn't file their notice of default. But what we do have here that we track is an appointment of trustee, where the bank will hire a new entity, a new company to go in and start that foreclosure process, usually 90 days out. So I track that as well.
Okay. And that happens real fast.
Very fast. In Texas, we do it fast, baby. Fast highways, fast foreclosures, fast executions. You know what I mean?
Yeah. I know it. So do you have any other examples? I mean, you've posted a lot, I don't want to catch you off guard, but do you have anything that stands out in your mind of all the projects that you've been posting about? You told us about the one in San Francisco, and
I mean, the one I came across yesterday, this 324 unit in San Antonio, was bought just a couple years, April of 2022. It was part of a CLO, a combined loan. I can't even never remember. Basically, it's combined, cross collateralized with another loan, another apartment complex of 276 units. So between these two properties, 700 units that the hedge fund, that Wall Street fund, basically paid $55 million for. All right, that's what they paid, not what was, that's not all it was financed. But both of those are going. They're going away. They're going to the foreclosure auction next month. That one really surprised me. A collateralized loan agreement, basically, is what it is, a CLO. So, that's our collateralized loan obligation.
So it sounds like a leveraging one asset to purchase another asset, almost like taking a line of credit out on one asset to.
Well, you basically it's just a cross collateralization. Now, there are some of these big firms that had $100 million, $1 billion in dry capital to go out and buy these properties, almost like they pulled them together. So if one goes down, guess what? It takes the other ones with it.
Yeah.
I saw there's a 624 unit, literally about a mile from my house here in Austin, that I drove by last week. not a bad looking house, but they can't afford the syndicators, operators aren't paying management. The property management filed like $150,000 lien against the property, so they hope they can get paid. But in a foreclosure, guess what? That's a
It goes
junior
away.
lien that gets wiped out, goes
Yeah.
away.
Wow. So what's your sense? This may not be up your alley, but you probably have an opinion anyway. And um, I could see, 2017, 18, even 19, it was really hard to predict that
Yeah.
coronavirus would come and then interest rates would shoot up as fast as they did. But it seems to me that there were a lot of syndicators in the middle of interest rates going up, or as interest rates were going up pretty sharply, they were promoting deals, multifamily deals, and getting into them. And I don't know, why the banks would go along with that, seeing that there was a high degree of uncertainty and the whole world was turned upside down. And they were raising a lot of capital to get into these deals at a time where interest rates were already going up. So do you have
So,
any
oh
opinions about
yeah,
that or insight?
I can give you insight on this because here's what happened. The people that were around for 2008, 2014, those people have all retired, got their golden parachutes, and moved on. And
Hmm.
what you have happening now, and this is banks still need to make profits. Financial institutions, Wall Street still needs to make profits of some sort. And so, yeah, they're willing to finance it. If a property papered out and it could fog a mirror at that 1.25 DSCR, and somebody was willing to bring 30% down where they're sitting in a decent leverage position, nobody has a crystal ball. You know what I mean?
Hmm.
And the way they look at it, it's like, well, if we do have to take it back, we'll take it back and we can operate it as an asset, put a receiver in it and operate it for a while until we sell it off. But you just have people at these banks and institutions that weren't around for the last crash. They now need to make money. They need to show their investors
Hmm.
positive returns. And so what you're going to see, I'd be very surprised if a lot of bankers or bank presidents aren't retiring early, taking their stock options to
Okay.
head off into the sunset. But it's just history repeats itself. You're gonna they get greedy. We need to do this, and everything keeps going up. Nobody wants to think ahead. I mean, 2020 is all. I mean, hindsight's always 2020. Well, I shouldn't have done that. I shouldn't have done that. Well, you should have thought about this beforehand. And like me, I've been through an up and down before. I'm like, why people are paying these ridiculous prices at 90, 95, or 105% of the cash flow right now doesn't make sense. But hey, they're getting investors to show up to seminars and
Yep.
fork over their 50 to 150 grand in an IRA to get it fun. That's what happens.
Yeah. So is it still happening right now, or is it kind of the tables totally turned the other way where syndicators have backed off and say, no, we can't oversell this anymore with the cat's out of the bag?
I've seen articles, and I've talked to some folks where there have been some contracts canceled, some purchases canceled based on what's going on, and so that's a good thing right now. People are like, no, the numbers just don't make sense, or we move into this. It's kind of like driving a brand new car off the lot. We're going to buy it now and lose 20% value in the next year the minute we drive it off because of comps and stuff like that. That's kind of what's happening. The real play here that I would tell you if I was this big apartment syndicator, but being the debt side of things, is any type of, when you start looking at these lenders and these companies who are foreclosing, a lot of them are portfolio lenders or small banks. I would be reaching out to them and say, listen, I'm willing to offer you an offering after you foreclose. Let's figure something out. Because a lot of times these banks will carry financing if they can get somebody off their books so they have to carry it. So it might be an opportunity, like, that $6 million property in San Francisco. If a bank bought it or bank took it back, they might be, if you could bring $1 million down, they carry the 5 million for a while. You really got to be conservative in your NOIs and your cash flows and stuff like that to figure that out. But there was an article up, but I think more private investors can get together and offer longer term financing, 10 years, 15 years on a lot of these commercial plays to kind of go through this up and down peak, just to kind of let it sit out and let the market settle for a little bit instead of being such a
Yeah,
knee
yeah,
jerk
that would be
reaction.
smart.
Yeah.
What is the play, for somebody like yourself and what you do in buying notes? It's it, if you can buy a note before it forecloses at pennies on the dollar or 10 cents on the dollar, is that a good play?
Let me correct you. We're not buying 10 cents on the dollar anymore for the most part of
Okay.
value. Now it might be 10% of what was owed based in the market values
Right,
being
right, right.
low,
Okay.
but it's all about what you're going to do with the asset. If you're going to take the asset back, part of the reason that foreclosure is so nice, and I hate to say that foreclosure is never used nice, but it's nice if you're notice is it cleans the asset, so you don't have any
Mhm.
junior liens or outstanding obligations. You
Oh,
really
I see.
technically
Yeah.
and that's the thing is if you can pick up something, you're probably still going to want to end up foreclosing and then expect to operate it. I mean, this is where partnering up with some apartment operators or
Mhm.
office operators, if you've got cash that can take it down and they're around for the long haul, that's going to be good. I often think about the movie The Big Short, one of my favorite ones, and
Mhm.
I think about Christian Bale's character in there, Michael Berry, who he plays in real life, and how for like 6 years his investors were like demanding him to cash out, and it was like a negative return, but he knew there was a big payout at the end. And so when everything finally the dust settled, he was able to give his investors a huge return because they hung around, and he just told them, no, I'm not returning your money until
Mhm.
this plays out. I think that's what's going to happen. I think you're going to have to obviously hold these for a period of time. And if you can break even and your investors or you are happy breaking even for a couple of years, it'll rebound. And as long as it's an asset class that's still needed, I would be buying office space to hold for office space. I'd be looking for either turning into, multifamily that's affordable, or if you're in a town that's got a lot of issues, maybe turn it into homeless housing. Maybe you can get some government grants, Section 8, stuff like that, because we still need a lot of that stuff in different cities. I made the joke today about that San Francisco thing. Hey, well, if they started turning it into a homeless housing, they would probably fill it up pretty fast and have the government pay them on a per person basis. That's kind of like what Blackstone is doing up in New
Mhm.
York State. They bought a lot of these single family homes above value at peak of the value, and now they're getting $400 or $600 per person in each house in each room. So if you have five
Okay.
people, that that house is now throwing off $2,500 a month in rent when market rent might be 1,200, and
Yeah.
they're just holding it for a period of time. And I wouldn't be surprised if we see more of that happen.
Yeah. Yeah. Hey, earlier you mentioned something about hotels, and you kind of, I think you had it in a different category in your thought process. Tell me about hotels. What's going on?
So it's a same similar thing, overpriced or areas that haven't recovered. What you saw do well probably during COVID have struggled as people have gone back to the normal living, and they're not living some maybe so rural or stuff like that. They're looking to basically get back to a bit normal. Hotels have been a mixed bag depending on where it's at. Some places are doing well, have recovered. Others are just downright in the dumps. And that's the thing is that something like that, a hotel. I saw at the COVID, I saw people that had a new hotel turn it into apartments because it's a pretty easy conversion
Mhm.
and something like that. Or people turned it like we've got a hotel down the street here that the city bought and is going to turn into elder care, senior housing, and
There
stuff
you
like that.
go.
You know,
Okay.
so those are some things to look at in a city by city basis. What the city needs. Maybe they're willing to sell. I mean, the guy that owned the hotel here was ridiculous. Something that maybe was only worth 5 or 6, they were able to sell for 11, and
Hmm.
just ignorance, ignorant
Okay.
spending by cities. I mean, heck, if you got a hotel in San Francisco, sell it to the city for almost.
Yeah. Yeah. Whatever it takes to cash out, right?
Yeah, I mean, hotels have been stressed for a while. There's stuff in Orlando is one of the big things. There's so many hotels down there that are struggling. As
Mhm.
things get more and more expensive, people are cutting back on vacations. They're not traveling as much, and the tourism industry is directly rated like that, and hotels are struggling.
So is there a parallel that you see between multifamily apartment complexes and hotels, or or they're tracking a little bit different because it's a different business model, actually?
Yeah,
Yeah.
it's a different business model. I mean, it's a real estate play, but it's a different business model. It all depends on the financing and how well that asset's been performing right now, and how if you can squeeze any more capital out of it. I got a buddy of mine who bought a hotel in Hot Springs, Arkansas. The and he bought it direct from a hedge fund. The hedge fund had foreclosed on it in 2020 and had operated it for 2 years. And he bought it for seven and a half million. It's a historic hotel right next to convention center, the Hot Springs Hotel, basically.
Mhm.
And he bought it, and the bank financed him 100% financed. They just went off the books, and they said, "Well, we'll give you a mezzanine loan for the 30% down that we want you to bring, but we'll give you that for 5 years." So he's got 5 years basically to refinance out the hedge fund on that second lien position, but he's got
Right.
long term financing in place on the first. And so that's an opportunity. If you can see that
Yeah.
and see what's going on and put effective management and market an asset to, drive in new rents, increase your rents, or drive in more heads and beds in the hotel aspect of things. That's what it comes down. To more than anything else.
So I want to transition in a minute to what you do and the note buying business and whatnot, and note selling and all that. But is there anything about what we just talked about that I didn't ask you or that you want to add in terms of the looming foreclosures on these big commercial deals?
Every state's different. Every state has a different foreclosure time frame. I mean, you're in Georgia, second fastest to here in Texas, 30 days there in Georgia. States like New York, 2 to 3 years to
Yeah.
foreclose.
What's a foreclosure? Yeah.
Yeah, exactly. You can just. I know a guy that
Free rent.
I had a guy that had a rental property, hadn't paid a mortgage in 7 years, never been foreclosed on. You know what I mean? He kept renting it, was making cash flow each month, and never paid the bank on it. I was like,
There you go.
Jesus.
Yeah.
So here's the thing: I would highly, if you're going to be looking at buying some of the stuff, you definitely want to identify states that are friendly to lenders, landlord friendly. Those are two of the biggest things. Make sure there's, most of these things aren't going to have a big redemption period, but you definitely want to check your taxes out on these things, see what's going on. If you can get the cash flows or the financials on these, that's one of the most important pieces of due diligence. I mean, you often have to feel like you're Sherlock Holmes, because if the borrowers aren't operating, they're probably not providing updated financials, the bank or the lender too, and that's what's leading to part of the foreclosure process.
Mm-hmm.
Just really do your due diligence. This is not something that you should look at today and then go make an offer tomorrow. Do a deeper dive, see what's going on. In the residential note business, we can send realtors and other people out pretty easy. It's pretty easy to pull comps with a CMA or a BPO or have a realtor.
Right.
From the commercial space, it's a much more in-depth process. You want to walk it. You want to see what's going on. Talk to the city if it's going to be a transition of an asset, and really get a feel for what the issue is, and if there's an opportunity. There's just going to be some of these assets that are just going to turn into zombie commercial buildings, vacant, that
Yeah.
nobody can do anything with because they're just too expensive. Maybe the banks don't want to take a discount, and then they go to tax sale, and then
Yeah.
you got to know what to do then too.
I think a lot of investors, this play of these buying these foreclosures is really for people with deep pockets and a long time horizon.
Yeah.
And it's not for the average Joe jumping into it.
No, I mean, it's not. I mean, it all depends on how motivated the bank is to the lender on this. I mean, the more motivated, the more stressed they are, they may be willing to play, take a little bit more of a haircut to be more flexible on offering you financing just to get it off their books, so it can turn into a cash flowing asset for them of some sort. That's something that, I mean, it does help to have bigger pockets, but you got to be patient. This is not if I'm gonna buy it and fix and flip it and get rid of it in 6 months. This is, like you said, it's a longer term play, but this is where we're going to see more wealth created in the next 4 to 5 years. And there's also going to be some folks who have had a lot of wealth that are struggling. I think New York City is a great example of that.
Mm-hmm.
Some of these well-known families are taking it on the chin. I mean, people are trying to sell. I had people reaching out to me during COVID trying to sell me fully leased apartment complexes in New York at 50 cents on the dollar. And I was like, there is something that smells really wrong with this. And I'm like, yeah, it's not worth the 50 cents. It may look like it's cash flow wise, but
Right.
long-term wise, no, it's not.
Right. So let's talk for a few minutes before we go here about your business and your note closing, note buying. You've got some podcasts and you've got a lot of valuable content that you deliver, and I think opportunity for investors to get into the note buying business. So let's talk about that a little bit. Just tell us about what you do and what's going on.
Yeah, we're very fortunate. I mean, I've been a big proponent that marketing is one of the first things that we do every day in and out. And we've got the #1 podcast, the Note Closers Show, out there. I released episode 871 this morning on
Oh,
stuff.
congratulations. That's awesome. Yeah.
Thank you. We've got the
You
#1.
are a social media content engineer or production company. I don't know.
The great thing is I work from home. I don't have to run around trying to do a million things. I work here from the Bat Cave.
Okay.
In the most part, but this is all I do. I mean, I don't have kids, not that I know of. I don't we got the 4-legged kind.
Okay. Yeah.
We love Austin here. It's nice. Austin's getting crazy though. But this is what I do. I love it. It's a great way to share information. I mean, I was very fortunate when I first got started as a real estate investor. I had like a 4-year apprenticeship learning the note business and the mortgage business. and attended so many conferences and seminars, being a guy in the back of the room taking copious amount of notes, that I like sharing that information. And we've got the number one YouTube channel, WeCloseNotes.tv. We teach classes on this. We have some coaching, but we make the majority of our money off of the actual deals that we do. And so we help people buy notes, whether it's a portfolio of notes. Like we've got an investor that reached out to us at a portfolio of 12 first liens up there. We're helping them sell. It's somebody that reached out to me and said, "Hey, can you negotiate on our behalf to try to buy this note on this commercial building?" I'm like, "Yeah, I can reach out to the bank, and I know what to say and what not to say to see about getting it for you and make some money off of that." But it's an interesting time, and I'm one of the few guys in the industry that actually talks about the distress side of note investing. It's a niche within the niche. Most people think note investing, they think of owner financing a property and
Mhm.
going that route. Well, I've been buying direct from banks for over 20 years. And so we just show you how to do that. So I have a free class. If you'd like to learn kind of the basics, it doesn't cost you a dime. You don't even need a credit card. If you go to noteweekend.com, you can take my, 1 day, 3.5 hour class, kind of learn the basics of note investing. And that can help you on the path to being more educated and going from there.
Okay, so tell me, describe the typical person that, the avatar, if you will, of the person that would connect with what you do, that would benefit by what you have to offer. What kind of I want my audience to really think about their situation and to
Yeah.
see if this might be a good fit for them.
So it's funny. I have students that are 17 up to 85, but the
Okay.
normal avatar of our listener and students is college educated, has a sales position, management position, homeowner, 35 to 65, making 75K to 250K a year. They're tired of working the rat race, or if they're a real estate investor, they're tired of dealing with toilet stands and trash outs. They're tired of dealing with rehabs
Hmm.
and want something a little bit more passive that they don't have to worry about, working so hard. They can buy this stuff and do stuff all across the country from where you're at on the case side. So they're looking for passive income, whether it's they're more active, maybe the non-performing side. They want to be more passive, buying performing or reperforming notes that they can get at a 8 to double-digit return or more on the
So
deal
the
side of
typical
things.
person that comes into your sphere, if you will, are they partnering with you and your company on deals, or are you training them to do it, be an independent contractor, if you will, and do it
Yeah,
on?
I'll partner with a few folks. We'll make partner with some of our coaching students, but for the most part, if people are coming to it, I mean, we'll show them how to do it, and I'm available for phone calls. You can schedule a phone call on my calendar at any time by just going to talkwithscottcarson.com. And the way I've always looked at it, John, is if I teach a person, if I give them a fish, you feed them for a day. If you teach them how to fish, you feed them for a lifetime. And my goal when I started teaching years ago was to show people how to do this, because hopefully when they do get a list of notes in or tape or an individual asset, hopefully they remember, hey, let me call Scott. Let me go talk with Scott Carson and see if
Right.
he can help me out in the deal. So we'll do some of that partnering. Or hey, you got a tape in? Well, I'm interested. I'll buy these assets and then call this person to buy those assets. So that's the whole goal
Okay.
for education.
It's a win-win. Yeah,
Yep.
yeah, that's great. Yeah, the networking, the value of networking in real estate investing as investors. I teach a monthly meetup, and I put not the amount of content that you put out on social media, but I put some content out there,
You do? Yeah, you
and
do great
I
stuff.
tell people all the time that the networking, coming to the meeting live, there's no substitute for it. That's how I do it locally here, and the local investors to meet. And I learned real estate investing by doing exactly what you're describing. So anyway, you're bringing great value to people that may not know. There's probably a lot of people listening that may not know and fully understand the tremendous value there is to doing that and connecting with you and your the content that you have. So that's awesome. Want to just give everybody an encouragement to sign up, log on, sign up, and get connected with Scott.
Well, we're here to help. But if you're listening to this or watching this, make sure you hit that subscribe button. Make sure you leave John a 5-star review. We, as podcasters and content creators, we like to hear from our audience and listeners out there and see how we're adding value to you. Sometimes it feels like we're out talking to the, into the space, but it's good to hear back from you. So I appreciate that, John. But you're doing an amazing job. And we met from a networking event out in Vegas a couple
Yeah,
years
that's right.
ago, and
That's
then
right.
I still talk with probably half that group.
Yeah,
It's
that's
funny.
great.
My phone's been ringing off the hook, or email's been ringing off the hook a little bit more often now on the distress side.
Yeah, I bet. That's great. Well, good, Scott. I'm going to leave notes in the comments in the notes section where people will have your contact information,
Yep.
links to your website, and all
Yep.
that. Is there anything else that I forgot to ask you about, or anything else to top off this episode?
I think the biggest thing is get educated. Educated, it's important. If you come from the fix and flipping side or mortgage side or the real estate side, that's great. It's good to have a knowledge, but this is such a different niche of real estate investing. It's a different mindset, especially when you're going with a banker's mindset that I have to take, and then the investor's mindset. You have to flip back and forth a little bit to see what makes sense. Because sometimes your investor mindset is going to tell you to do something that would not be good as a banker mindset. So get trained. So we've got the free class for you to take to learn. And if you really are interested, then let's jump on and carry on a call and see if it's the right fit for it. For some people, it's not a fit, and that's okay. But I'll tell you this: get in the game, do something. It's still a great time to buy real estate. I mean, real estate basically doubles every 7 years on the residential side or sooner. If you can afford to get into it, just get in the game somehow. Get networked, partner up with people. That's the most important thing. That's where I'm at today, because I've partnered up with people and learned and networked my ass off.
Yeah, that's great advice, Scott. And I'll just add or emphasize what you said this way, that there are so many different ways to make money investing in real estate.
Yeah.
And whether it's note buying or buying rentals or whatever, and market conditions may dictate maybe some of those strategies aren't good, but it sounds like the note buying business is always good if you know what you're doing and you have the right training. So sign up for
we've
Scott's class.
we've had ups and downs. I mean, there's some times where it wasn't as much inventory on the normal side of things that we would see, but there's always distressed debt. I mean, with 80 million on the residential side, if there's 80 million mortgages out there and we have a 2 to 3% default rate, that's still a lot of distressed stuff hitting the markets, and we're just going to see those numbers continue to climb.
Yeah, yeah, absolutely. Well, Scott, thank you again for coming on today's podcast. Great seeing you.
Yes, thanks for having me, John. Honored as always, bud.